Today we're going to be covering vertical spread options strategies. Hey, what's up guys? This is Sam Shames, VP of Options over at Simpler Trading. I wanted to cover this topic because it's a very good strategy to use. I think it'll be one of the more common strategies that you're going to come across in terms of trading options. It's a good strategy if you're a large trader. It's a good strategy if you're a small trader. It's an especially good strategy if you're a small trader and you're looking to trade larger price stocks. And it's a strategy that I think once you've mastered will become a staple in your trading and probably become one of your top three, if not your very top strategy that you choose to use when you're looking at different option strategies. So let's start off with the basics. What is a vertical spread? And we'll start off with kind of the most commonly known one, which would be kind of the vertical call debit spread. So whenever you do a call debit spread, typically you're going to be buying a call and then selling another call against it. I'm using Netflix here as an example because it was a rather ideal chart that we were looking at on Monday in the room, and it's also a large price stock. So not everybody's going to be able to swing, $5K for in the money Netflix call, and because of that, that's when the vertical strategies come into play. So let's start with the basics, which is what is the vertical debit. And in the case of Netflix here, we could just use any numbers. Let's say we were to use the 1250 as the long call. So this is the one that we want to buy. And then we're going to use the 1300 as the short call. So we're going to sell the 1300 and buy the 1250. Okay, so in that case, we now have a 1250, 1300 call debit spread. We're long the 1250, we're short the 1300. When you look at your platform, I'll just set it up for the monthly expiration, and this is what it ends up looking like. So we would be looking to buy the 1250 and sell the 1300. What I like to do is come over to the 1250, right click, go to buy, go to vertical, and then we change the lower one to the one we want to trade. In this case, we're going to go with the 1300. And that gives us our vertical. So even with this adjustment, you can see that the price of the vertical is rather large. It's about $25 for the trade. But also note that the call itself, the $1,250 call, is about $73 right now, right? So by doing it as a vertical as opposed to just a straight call, we've reduced the price by over 60%. So we're paying only 1/3 of what we would pay had we just bought the call. Now, of course, if you have a smaller account, this might be still too large. And also understand that this is also in the money by quite a bit, and it's 50 wide. So you can always make it more narrow. I think if you have a smaller account here, probably what I would do if I had a smaller account is something like 1280, 1300. Would make sense for a smaller account. You could also just narrow the spread, make it something like 1290, 1300, make it $10 wide. At the end of the day, you're really saying the same thing. It's just a matter of how much risk do you want for your account. So that is the call debit spread. It's basically in this case going to be 50 wide. Our total cost on this is about $25, and I actually think that $25 is about the right price. The reason being is because it's 50 wide and we're paying $25 to get in. So what's our risk? Our risk is that Netflix goes to zero and we risk $25 or $2,500 per contract. The upside is that Netflix, goes bonkers and goes well above 1300, or even if it frankly just stops at 1300, this trade would go out at max profit and we'd make 50. 50 minus 25 would leave us with a $25 profit. So our risk to reward here is exactly 1-to-1. Which is not a bad risk to reward when it comes to verticals. You typically want to try to get about at least 1-to-1 on these, in my opinion. I think the sweet spot is if you can get somewhere around 2 or 3-to-1. I think that's kind of the sweet spot. But when you're paying 1-to-1, you know that you're getting kind of what I would just consider fair value for that spread. You're not overpaying, you're not underpaying, and you're getting a nice mixture of direction as well as minimal theta. And that's another thing here with the debit spreads is that when you do it as a spread as opposed to just a call, If you were to do it just as a call, you would lose about $100 per day on this call by itself. If nothing happened, like price could just stay completely zeroed out for the day, just with the passage of time, you would lose about $130 per day on that contract. Whereas if you do it as a vertical, you actually negate this and you would lose almost nothing per day, because what you're losing on the long 1250 in terms of theta decay, you're making up for because you're getting theta decay from the 1300. So pretty cool strategy there. The flip side of this would be to do it as a put credit spread. So call debit spread is a bullish expression. Very simple, right? Very simple way of looking at things. The flip side of it would be to do it as a put credit spread, which is oftentimes, in many cases, actually the preferred way to do it. The call debit spread will have a little bit more risk and a little bit more reward and be slightly less consistent, whereas the put credit spread will be more consistent but have a smaller risk, or excuse me, have a smaller reward available. So in this case, let's say that we still wanted to take Netflix to 1300, but in this case, instead of going to 1300, let's just do the at the money. So let's say that we think Netflix can at least hold 1275, which is the current price. So in this case, we would go over here to the put side of things. We go to sell, we go to vertical, and in this case now we're selling the put. Just because it's on the put side doesn't mean it's bearish though. In this case, being on the put side, because we're selling the put, it actually becomes a bullish trade. So in this case, let's make it 50 wide again just for consistency. And you can see right away the difference here. Although this actually isn't too bad of a price either. So in this case, it's another 50 wide spread, 75 to 25. You're selling the 75, you're buying the 25 as protection. You're getting about $22 worth of credit for this. So it's 50 wide, you're getting $22 of credit. How much risk do you have on this trade? Well, it would be 50 minus 22, which would be about $28 worth of risk. So immediately you can kind of see the play here of how it all works. With the first option that we had with the call debit spread, it was 25 risk to 25 reward. With the put credit spread, it's 22 reward versus 28 potential risk. But with this one, you actually don't need it to do anything, right? Because keep in mind, as long as Netflix were to hold right around 1275, which is the current price, this option will decay. Every day that passes, you're going to make money, because as long as nothing happens and price stays pretty much exactly where it is or higher, this put option is going to continue to decay, and that will continue to put money in your pocket as long as nothing happens. In the event that truly nothing were to happen between now and July 18th, Netflix could literally trade in a sideways line. Doesn't have to go up a penny from there. Then this option would pretty much expire worthless, and you get to keep the full credit, which in this case right now is about 22 bucks. So that's kind of the long yet still very short version of the vertical spreads. And I'm using just the call side, excuse me, I'm using just the bullish expression of this. However, you would just flip what I just told you for bears. So for bears, the debit spread would be done on the put side, the credit spread would be done on the call side, right? So just take everything that we just talked about and just invert it to get a bearish expression if that is how you want to play the market, to the bear side. So let's move on now to the stuff that's a little bit less commodified. I think that if you have any other questions regarding the construction of these types of spreads, there's tons of resources out there that are free, and that are kind of bare bones, kind of basic stuff that allows you to build up your knowledge on this. I prefer to maybe speak to the little bit more nuanced stuff. So I just wanted to start with the ground floor to make sure that we're all on the same page in terms of debit spreads, credit spreads, and then kind of showing you basically when to use them, when they're the best strategy to use and whatnot. So let's move over to the charts, and now we're going to talk about when to use debit spreads or credit spreads. So in this case, I'm going to continue to use Netflix because it just had a very clean signal. It's an extraordinarily clean chart as well. You can see that you got signals here, and then you got a confirmation of the signal here. And pretty much ever since then, all you've gotten is just reload signal after reload signal, right? We were looking at this one in the room earlier this week, And I was looking to do it actually as a broken wing butterfly. Now, that's probably a topic for another video. That's certainly much more nuanced and maybe slightly more complex. But the broken wing butterfly and the debit spread actually are not that different. So in this case, I'll just speak to it as if it was a debit spread. We're looking at something here that we want to ask ourselves, when do we want to use this strategy? And the debit spread or the put credit spread, I mean, you can use them interchangeably. Really, I'll continue to talk about the debit spread side of things, but just understand the credit spread is the same thing. It's just going to give you less reward and slightly less risk, right? So we'll focus on the call debit side of things, but understand everything that I'm saying can be completely inversely applied to the put credit side of things. They're both bullish expressions of the idea. Just one is a little bit more conservative, one is a little bit more aggressive. So when do you want to use the call debit spread? I would say that you want to use a call debit spread when you see a stock that is about to have what you think is a directional move, right? So if you expect a stock to have a directional move, then I think a call debit spread or a put credit spread are completely valid and good ways to try to capitalize on that, especially when the stock is big, right? Because not everybody's going to be able to go out and spend, $7,500 for one contract on Netflix. You'd have to have a pretty big account. I would say probably need to have at least 200 to 300K in that account to make that a justifiable expense. Also, let's just say that you have a very small account. Let's say you have a $5,000 account, a $10,000 account. In that case, you can't really even trade Netflix with that account, but you can if you were to do it as a vertical. So when do I want to use the vertical? I want to use the vertical when I have a signal that a stock is about to have a big directional move. In this case, you see right here on Netflix how you went into this one dot squeeze. This is when we were looking at it. We were looking at it on Monday to try to capitalize on this. We did all this work across the markets. We looked at the indexes, we looked at the sectors, and we looked at the stocks. And we started with the index level, the big top-down point of view, and we asked ourselves, okay, do the indexes look bullish or bearish? And they looked bullish. Okay, then we move to the sector, and we ask ourselves, okay, well, we want to be bullish. What sectors are giving us the best edge? And we noted that tech was one of them, Mag 7 stocks were another, and high momentum tech specifically was another. We also noticed that there was a lot of good signals coming out of the XLC, which is communications. So before we even got to Netflix, we checked all these other boxes and we said, okay, well, we're looking for a tech stock. We're looking for a tech stock that's in the communications sector, and we're looking for a tech stock that is Mag 7, and we're looking for a tech stock that is already showing us momentum. And Netflix checked every single one of those boxes. When we pulled up the chart, we noticed that it also had a daily squeeze, and it also had this arrow, which it technically doesn't need because it already had a green arrow from way back here. But, nothing beats a good level of alignment, and that is certainly it. So in that case, that's a good spot to use the call debit spread, is when you see a directional move setting up in a stock, and you want to take advantage of it, and you want minimal theta burn, especially if it's a larger stock, or if you have a smaller account and you want to trade a larger stock. These are all great ways to do it when it comes to directional trades. Let's talk about something else. Let's talk about the IV. So IV is also pretty helpful here. So in this case, I actually have a label that I use for this. This is a label that we have available in the Simpler Trading Room. You can probably find one floating around as well if you don't have it, but I do find it to be helpful. Notice how the IV rank here is 43. When the IV rank is gray like that, then the IV is not cheap and it's not expensive, right? It's kind of right in the middle. And when the IV, I would say, is between like 30 to 50, I think you could do either strategy, right? So kind of the rule of thumb that I use is if the IV rank is between 1 to 30, I look to buy it. So in that case, I would do call debit spreads. If it's from about 31 to about 50, you could do either one. So it doesn't give you a ton of edge either way. It's not expensive, it's not cheap. And then if it's over 51, typically I want to be doing put credit spreads. I want to be selling premium in that situation. Right? So it's just kind of a loose rule of thumb. but just kind of looking at it in thirds. The first third, if the IV rank is between 1 to 30, I want to just go ahead and buy the call debit spread. If it's from 31 to 50, you can do the call debit spread, or you can do the put credit spread. If it gets above 51, that's when I definitely want to be doing put credit spreads, because that's telling me the IV is starting to get a little bit rich compared to its historical mean, and you'll actually give yourself a little bit more advantage by selling the premium over time. So that's a pretty cool label there. If you're a member of the room, you can grab that from the room drive. Let's use another example here. So let's just kind of take a look at a couple of other things. Like let's maybe take a look at, let's just look at SPY. So if you recall, we were just talking about the IV rank and when to do what. So as we look at SPY here, you can see there on the top right, the label. Notice how this time it's green and it's 16 is the value. And with a 16 rank, what would we want to do here on SPY if we're looking at this? Do we want to be selling premium, or do we want to be buyers of premium? Meaning, sellers of premium would be put credit spreads, buyers of premium would be called debit spreads. I would argue that in this case you want to be a buyer of premium because of the formula we just looked at, right? So between 1 to 30, we want to do it as a call debit. As it approaches 50 and higher, that's when we start to edge out and go to a put credit spread. So with an IV rank of 16, frankly, I think you could do put debit spreads or even calls in this situation, and try to take advantage of it. Let's see if I could find a red one here. I think MU's due for earnings today, so let's see if they're red. And not even MU with earnings today is red. Maybe Circle? We might not be able to find one that's red. I think I saw Procter & Gamble, of all things, had a red one. Let's check. Nope, this one's green too. Off the top of my head, I can't think of one that is a red label, but it doesn't really matter. Let's just go back to our little formula here. The IV rank, and you could find this in a lot of different places. You don't need the label. You just have to look into your platform, and it'll show you the IV rank. The IV rank is just basically its IV relative to itself over time. So again, if it's between 1 to 30, I want to be doing it on the debit side as a debit spread. If it's between 31 to 50, I think you could do it as a debit spread or a put credit spread, completely up to you. If it's over 50, then I would prefer to do it as a put credit spread. Okay, so that's just kind of my rule of thumb on how to do that. Also keep in mind that if you're doing it as a call debit spread, you're going to be a little bit more aggressive with the expression of the idea. Oftentimes, if you're doing it as a call debit spread, price actually needs to go up to make money for the trade. While if you're doing it as a put credit spread, while you're going to get lower reward, price doesn't usually have to do anything if you're selling the at the money put. So a little bit of a trade-off there, right? On one side, higher reward, but price has to move in your favor. On the other side, lower reward, but price has to do less for you to become profitable on the trade. In terms of picking strike prices and expirations, I really think that is a long class unto itself, but I'll just kind of give you my rule of thumb on it. What I typically like to do is one of two things. I will either A, do the at the money, which is going to be the delta 50, and that's the at the money call. And then typically I'll sell like the delta 20 against it. I think that's one way to do it, right? And thinking in terms of deltas, right? Notice I could give you a strike price and say 1250 or 1200, but that's not really helpful to you unless you're trading Netflix. If you're trading something else, the strikes would be completely different and you would change your strategy. Whereas if I quote it to you as delta, then you know delta 50 on Netflix is the same as delta 50 on Walmart or any other stock. So this is kind of a very common one, would be delta 50 long, delta 20 short. Another one that I think you could do that I think is also a pretty good way to do this and is pretty conservative and still probably one of the better ways to express an idea would be something like a delta 70, and then you'd be short like the delta 30, right? So in this case, this would be deeper in the money, while this one is at the money. So what would be the trade-off here? Well, this one's going to be more consistent but lower reward. This one would be less consistent but higher reward. So you just have to ask yourself, which one do you want to use? Again, I would speak to you in deltas as opposed to just at overall strikes and say look for delta 50 and delta 70, and then you can choose which one you want to sell against. Normally if I'm doing delta 50, I'll sell the delta 20 against it. Normally if I'm doing delta 70, I'll do the delta 30 or the delta 20 against it. I think, and frankly, my preferred one is actually this one, in case you care to know. So that's how I would choose the start price. The at the money is going to be usually the delta 50. Deeper in the money will be the delta 70. In terms of choosing expirations, that really just depends on what you're trying to do. So one thing that I would say is, if let's say that you're trading like a daily squeeze. Okay, so how many bars does a daily squeeze typically go? On average, they go about 8 to 10 bars, right, once they're fired. And that applies to any time frame. So that's a daily time frame would be 8 to 10 bars, a weekly time frame 8 to 10 bars, an hourly time frame is 8 to 10 bars. So I try to give myself enough time to see that particular setup through. In the event that I'm trading a daily squeeze, then I want to give myself at least, if it's a daily squeeze that hasn't fired long, understanding that daily squeezes can go 8 to 10 bars, I typically will give myself somewhere between 14 to about 28 days on the trade, right? Because I want to give myself a little bit of wiggle room in case, I'm not immediately right. And using this as kind of a way to think about it makes sense to me. If you're trading longer term, let's say that this was, instead of a daily 8 to 10 squeeze, you're looking at a weekly 8 to 10 squeeze, then you have to just adjust for that. So 8 to 10 weeks would be something like 40 to, let's call it 70 days. Right? So you get what I'm putting down here. This would be a daily squeeze. This would be a weekly squeeze. What if you're trading an hourly squeeze? Well, an hourly squeeze would be about 8 to 10 bars. So 8 to 10 hours. So that would give, normally I'd give an hourly squeeze, maybe about 3 to 5 days worth of time till expiration. Right? So you see how the expiration date is completely dependent on the time frame and the setup that you're following. If you're following an hourly time frame, you can give yourself less time. If you're following a daily, you want to give yourself more time. And then, of course, if you're following a weekly, you want to give yourself even more time than that to see the setup through. These are all rules of thumb. In the event that the squeeze happens much faster, then you'll make more money if you have a shorter expiration contract. So do understand that. But just as a general rule of thumb, to start and kind of build your knowledge on this, this is kind of what I would suggest here. For an hourly squeeze, about 3 to 5 days out. Daily squeeze, about 14 to 28 days out. Weekly squeeze, about 40 to 70 days out. I think is kind of good rules of thumb in terms of choosing your strike prices. So once you understand this, then this tells you where to use your what date to use as your expiration. And then going back to the previous conversation around delta, then you just have to choose what delta to use. Again, typically something like delta 50, delta 20, long the 50, short the 20, long the 70, short the 20, short the 30. Those are all good ways to start as well. And I think that might be coming to a conclusion there in terms of, let's call it a deep introductory dive, right? Because this conversation could be one that we could have for many, many, many hours, getting into all the nuances of all this stuff. But I think that as long as you understand kind of the general concept as to when to use it, understand that the risk to reward is a little bit different between credit spreads and debit spreads. Debit spreads have a little bit more reward, but price needs to move. So more things need to happen, but you are compensated with higher reward. Put credit spreads, less needs to happen in terms of price movement, but the reward is also smaller. So you have to make sense of that, and you can do that with your IV rank. Going back to the IV rank conversation, if you have a high IV rank, then you typically want to be on the selling side of premium. So doing the put credit spread. The lower the IV rank, the more I want to be on the buy side of premium. So that means that I want to be doing the debit spreads more so than the credit spreads. The setup determines what expiration we use. So with the center point of most setups that we do here would be the squeeze. Understanding the squeezes go about 8 to 10 bars, then that starts to shape our expiration expectations. So 8 to 10 bars on an hourly, 3 to 5 days. 8 to 10 bars on a daily, somewhere around 14 to 20 28 days, and on a weekly somewhere between 40 to 70 days, and it all just depends on what time frame the setup that you're trading is on. All right, guys. Well, that is it. So we'll go ahead and wrap it there. If you have any questions, go ahead and drop them down there in the comments below, and I'll come down and do my best to answer them. And it'll also help us with any future follow-up videos to understand what questions you guys may have. So I hope this was helpful to you. We spoke in terms of kind of general rules of thumb, but I think that these are universally helpful because now you have a rule of thumb as to when to use what strategy based on the IV rank. You have a general rule of thumb as to what deltas to use for your strikes, and you also have a general rule of thumb in terms of what expirations to use for your contracts. So great way to get started. Go out there, do a couple yourself, get familiar with them. I think over time you'll note that these will become a centerpiece of your trading. Very critical strategy to master as options traders. And any questions you guys may have, just drop them down there in the comments, and I'll come back and we'll answer them and follow up on a subsequent video on any questions that you guys may pose. All right, guys, that's my time. Thanks as always for joining us for this. I hope it was helpful, and I'll see you for the next video.
Hey traders, this is Sam with Simpler Trading. I want to thank you for watching today's video. Hopefully you found the information in it helpful. If you did, leave us a like, leave us a comment. It really does help us out with the algorithm. And if you want to see us trade live with our own real money and be part of the community, come and check us out at simplertrading.com.